Hey guys, welcome back to the Bitcoin Fortress podcast, episode 220. Today is June 14th, 2026. We are recording at block height 953666. Moscow time is 1564, and fees are beautifully boring at 1, 1, and 1. That is always a good place to start. The network is working, blocks are coming in, fees are low, the mempool is quiet, and while markets continue to act emotional, Bitcoin continues to act mechanical. This week's theme is simple. Bitcoin is being stress tested from every direction: price, regulation, treasury companies, mining economics, AI distractions, stablecoins, and surveillance. And it is still doing exactly what it was designed to do. The fiat world is noisy. Bitcoin is not. And with that, let's jump into the news, starting with market structure, ETF flows, and investor attention. The first story this week is ETF flows. US spot Bitcoin ETF snapped a 5-day outflow streak from roughly $85.8 million of inflows on Friday. Talking points here. Important things to remember that this is not a huge number, but the direction matters. After several days of outflows, the market needed to see whether ETF demand was completely broken or simply taking a breather. The right way to frame this is not institutions are gone, it's more nuanced. ETF demand has become cyclical, sensitive to liquidity, rates, and risk appetite. That is normal. Bitcoin is now plugged into the traditional financial system through ETFs, and that means it will increasingly reflect flows from wealth platforms, advisors, hedge funds, and macro allocators. The key point for us, ETF flows are not Bitcoin. They are one access point. They affect price at the margin, but they do not define the network. CoinDesk reported that BlackRock and Fidelity are quietly dominating the spot Bitcoin ETF market. On major inflow days, IBIT and FBTC have accounted for the overwhelming majority of new capital. This is important because it shows institutional Bitcoin exposure is centralizing around the strongest distribution machines. This is not surprising. BlackRock and Fidelity already own the advisor channel. They already have trust. They already have retirement account infrastructure. So when Bitcoin enters the legacy system, it naturally enters through the most powerful legacy pipes. There is a tension here. On the one hand, this is bullish for adoption. On the other hand, it reinforces why self-custody remains the heart of Bitcoin. ETF adoption is good. ETF-only Bitcoin culture is not. Another CoinDesk piece noted that total US spot Bitcoin ETF assets have slid back toward levels seen shortly after the 2024 election. That is a powerful framing point. We have a more favorable regulatory environment, more institutional access, more treasury adoption, and yet ETF AUM has not meaningfully broken out. Why? Because price matters, liquidity matters, and narratives matter. The AI trade has been sucking up the oxygen. Inflation concerns and rates have hurt long duration risk assets. Bitcoin is still being treated by many allocators as a high beta liquidity asset rather than a neutral reserve asset. This is where conviction matters. Bitcoiners understand the asset differently than allocators do. Allocators ask, what is the next quarter's catalyst? Bitcoiners ask, what survives the next 30 years? Bernstein argued that weak Bitcoin ETF flows in 2026 are more about investors chasing AI than fears over quantum computing. This is a very important market psychology story. The market is not saying Bitcoin is dead. The market is saying AI is more exciting right now. That matters because capital flows toward the hot story. But Bitcoin does not need to be the hot story every week. Bitcoin is the base layer story. AI is the productivity boom story. Those two things can coexist. In fact, the deeper point is that AI may increase the need for Bitcoin. If AI accelerates productivity, automation, capital intensity, energy demand, and social disruption, then people will need neutral, scarce, seizure-resistant money even more. AI may be the shiny object, but Bitcoin is the foundation. Moving along to corporate Bitcoin treasuries and digital credit, Strategy purchased another 1,550 Bitcoin for about $101 million during the June 1st through 7th period. This is classic Strategy. The company continues to accumulate through market weakness, but the story has changed. The market is no longer treating every Strategy purchase as automatically bullish. Investors are now asking harder questions about capital structure, leverage, preferred equity, debt, liquidity, and MNAV. That is healthy. The first phase was simple. Company buys Bitcoin. The second phase is more sophisticated. At what cost of capital, with what balance sheet risk, and with what shareholder alignment? This is where Bitcoin treasury companies move from meme to credit analysis. In fact, Jack Mallers even talked about this in his recent podcast, that breaking down Strategy basically, and talking about how you have these different constituents. You have the common shareholders, you have the preferred shareholders, and then you have, of course, the Bitcoiners. And can you make everyone happy? Maybe in the long run, but in the short run, somebody's going to be unhappy. If you sell Bitcoin, the Bitcoiners are unhappy. If you sell more common stock to fund preferred dividends, then you make the common shareholders unhappy. If you don't adequately fund the preferred, then the preferred shareholders are unhappy because it doesn't trade at par. Or maybe they're worried about getting their 11.5% dividend. So, very interesting dynamics in Strategy now. And it'll be interesting to watch. But they're, of course, the biggest and the first. So, the rest of the treasury industry will have to take careful notes. The Financial Times questioned whether Strategy's recent behavior shows a more cautious posture, raising liquidity, buying back converts, using preferred equity, and managing obligations more carefully. So, just as I was saying, this is a great topic, again, because it separates Bitcoin conviction from balance sheet management. Strategy can be bullish on Bitcoin and still need to manage liquidity. Those are not contradictions. The real question is whether the treasury company model works through a prolonged bear market. In a bull market, leverage looks brilliant. In a bear market, capital structure becomes the story. For Bitcoiners, this is a reminder. Bitcoin has no liabilities, but companies, they do. BitcoinTreasuries.net shows a growing public company Bitcoin treasury universe, with Strategy still dominant, but many other firms now using some variation of the model, including the very hyped SpaceX, which has a rather large Bitcoin treasury that they disclosed. This is one of the biggest underappreciated stories in Bitcoin. We now have ETFs, miners, exchanges, and treasury companies. That means Bitcoin has multiple public market expressions. The good news, more balance sheets are absorbing supply. The risk, some companies will use Bitcoin branding to raise capital without having durable businesses or disciplined treasury policies. The market will eventually separate real Bitcoin balance sheet strategy from financial engineering cosplay. Moving along to mining difficulty, hash price, and network security. Hash rate index described the week as rough for miners. Bitcoin price down, hash rate down, difficulty unchanged, fees up slightly, and hash price down. Mining is where Bitcoin's abstract monetary policy becomes physical. Miners are under pressure when the price falls, fees stay low, and difficulty remains high. Their margins get squeezed. Weak operators turn off machines. Efficient operators survive. This is exactly how Bitcoin is supposed to work. The network does not bail miners out. Difficulty eventually adjusts. The strongest miners remain. Bitcoin mining is capitalism without a central bank. Coin Wars showed Bitcoin difficulty around 124.93 trillion near block 953662 with a notable downward adjustment. And of course, for the home miners out there, this is always an exciting time because who knows, maybe you'll find a block. This is useful for the rest of us, though, who mine or follow network health. The difficulty drop is not a failure. It's Bitcoin's self-correcting mechanism. If hash rate leaves, difficulty adjusts down. Block production normalizes, and miners who remain online see improved economics. That's the beauty of the system. There's no committee, no emergency meeting, no Federal Reserve press conference, just code, incentives, and adjustment. Fees are 1, 1, and 1 today, which is great for users, but also means miners are relying mostly on subsidy rather than transaction fee revenue. For users, low fees are wonderful. You can consolidate UTXOs, open channels, move funds, and manage custody cheaply. For long-term security debates, low fees raise a recurring question: what does the fee market look like as subsidy declines? My view? This is a long-term issue, not a current emergency, but it is worth tracking. Bitcoin security today is extremely strong, but the long-term fee market is one of the most important open economic questions in Bitcoin. Moving along to regulation, stablecoins, and the fiat system absorbing crypto. A new BIS working paper examined whether dollar-backed stablecoin flows affect short-term U.S. Treasury yields. This is a fascinating bridge between crypto and traditional finance. Stablecoins are not just crypto casino chips anymore. They are becoming buyers of treasury bills. That means they are becoming part of the plumbing of the dollar system. This matters for Bitcoiners because stablecoins are not Bitcoin. Stablecoins are digital dollars. They extend the dollar system. Bitcoin exits it. Stablecoins may be useful payment rails, but they are not neutral money. They are tokenized liabilities tied to banking, regulation, sanctions, and treasury markets. The Treasury and OCC have been moving forward with implementation of stablecoin rules under the Genius Act framework, including AML, sanctions compliance, issuer treatment, and restrictions around yield. This is the dollar system formalizing stablecoins. The message is clear. Stablecoins are welcome, but only if they become regulated extensions of the existing financial system. That is why Bitcoin is different. Bitcoin does not ask to become a regulated issuer. It has no issuer. Stablecoins are fintech. Bitcoin is monetary protocol. Market structure reform remains the key legislative question for exchanges, brokers, DeFi platforms, token issuers, and the broader crypto industry. For Bitcoin specifically, clarity matters less than it does for the broader crypto industry because Bitcoin already has the cleanest regulatory profile. But Bitcoin still benefits from clarity around custody, exchanges, ETFs, lending, accounting, and institutional participation. The danger is that crypto regulation becomes a Trojan horse for surveillance, KYC expansion, and permissioned access. Good regulation clarifies property rights. Bad regulation turns every wallet into a checkpoint. Bitcoiners should support clarity, but not compliance theater that destroys the point of open networks. And on that topic, Clarity Act is on the agenda for the Senate to consider, but they only give it a 60% chance of making it to the president's desk this year. They had an aggressive goal of July 4th. Probably not going to happen. Maybe after the recess, but who knows. So we'll continue to follow that one here. Moving along to privacy, surveillance, AI, and freedom tech. TFTC covered the UK government's reaction to unrest in Belfast, tying it to device surveillance, platform control, and resistance from privacy tools like Signal and Mullvad. This is not strictly a Bitcoin market story, but it is absolutely a Bitcoin culture story. Bitcoin exists because the digital world needed money without permission, but money is only one part of sovereignty. Communications, identity, location privacy, and device security all matter. A person who holds Bitcoin but communicates, transacts, and lives entirely inside surveilled systems is only partially sovereign. This is why privacy tools are not paranoia, they are basic digital hygiene. TFTC also covered calls for a more formal AI regulatory apparatus, including concerns that centralized AI testing and deployment approval could become a gatekeeping system. This connects directly to Bitcoin. Bitcoin was created to remove money from centralized gatekeepers. AI is moving in the opposite direction. Enormous compute, enormous capital, enormous regulatory capture risk. The danger is not just AI. The danger is AI plus state licensing, plus financial surveillance, plus speech controls. Bitcoiners should care about open source AI, local compute, encryption, and permissionless tools because the same fight is playing out across every layer of the digital world. Marty Bent's The Moral Case for Bitcoin is worth mentioning because it gets back to first principles. Broken money causes capital misallocation, social decay, and distorted incentives. This is the kind of story I love because it reminds us that Bitcoin is not just a price chart. Bad money makes people short-term. It rewards leverage over savings. It rewards proximity to money creation over productivity. It punishes prudence. Bitcoin is moral because it restores consequences. You cannot print your way out of bad decisions on a Bitcoin standard. That is why Bitcoin is hope, not as a slogan, but as an incentive structure. TFTC's generational entry piece argued that every Bitcoin bear market bottom has been higher than the previous cycle's top. This is a great psychological reset. In 2015, Bitcoiners panicked at prices that would later look absurdly cheap. In 2019, the same thing happened. In 2022, the same thing happened. Now, people panic around levels that would have seemed impossible a few cycles ago. The lesson is not price always goes up tomorrow. The lesson is that Bitcoin monetization is volatile, but the long-term adoption curve remains intact. You do not get generational upside without generational discomfort. Moving along to Bitcoin podcast universe themes, TFTC's Anger is the Buy Signal episode is useful here. The discussion around cohort level sentiment suggests that pleb frustration is high, while long-term conviction remains strong. That divergence is interesting. Tourists leave when price is boring. Conviction holders get louder internally but quieter externally. That is often when the best accumulation happens. Chris Martinson's recent TFTC appearance argued that inflation could return in a second wave with comparisons to the 1970s. Whether you agree with the exact forecast or not, the broader issue is right. The fiscal problem has not been solved. Debt, deficits, entitlements, and interest expense remain structural. Bitcoin is not a CPI hedge for next Tuesday. It is a hedge against the long-term political inability to preserve money. TFTC's Bitcoin Treasury for Business episode with Scott Marmol focused on how private businesses can think about Bitcoin Treasury strategy. This is more interesting than public company copycats in some ways. Private owners do not need to impress Wall Street every quarter. They can think in decades. Bitcoin Treasury strategy may be cleaner inside owner-operated private companies than in highly financialized public vehicles. TFTC's episode with Max Guys on wrench attacks is a reminder that custody is not just hardware wallets. It is privacy, key distribution, inheritance planning, time delays, and reducing physical attack incentives. The more Bitcoin succeeds, the more operational security matters. The goal is not to be paranoid. The goal is to make yourself a bad target. And finally, TFTC's post-quantum migration discussion from PubKey focused on BIP360, BIP361, institutional concerns, and the need for sober engineering rather than panic. Quantum is not an immediate emergency, but it is a serious long-term engineering topic. Bitcoin's culture is conservative for a reason. We do not casually change the base layer, but we also do not ignore real future risks. This week's featured essay is A Bitcoin Way of Life. Week 4, the series is about letting Bitcoin shape how we live, not just how we invest. Week 4 continues the idea that Bitcoin is not merely an asset allocation, it is a discipline. It changes how you think about time, consumption, risk, family, work, and responsibility. The key transition: most people want Bitcoin to make them rich quickly, but Bitcoin's deeper gift is that it teaches you to become the kind of person who can hold wealth wisely. That means patience, lower time preference, better habits, more independence, more responsibility. Bitcoin is hope, but not because it removes struggle. Bitcoin is hope because it makes struggle meaningful again. Before we wrap up, I want to mention the 4 Bitcoin Fortress books. First, Bitcoin Fortress, a simple guide to Bitcoin for beginners, the easiest place to start if you're new to Bitcoin or trying to help someone understand it. Second, Bitcoin Retirement and Estate Planning for people thinking seriously about IRAs, inheritance, custody trusts, beneficiaries, charitable giving, and long-term family wealth. Third, The Bitcoin Lifestyle, about how Bitcoin changes daily life, habits, discipline, and personal sovereignty. And fourth, the newest book, The Architecture of Money, which is about the structure beneath the monetary system, why fiat fails, and why Bitcoin represents a fundamentally different architecture. All 4 are written to help normal people understand Bitcoin not as a trade, but as a fortress. Well, that wraps up episode 220. The market is tired, ETF flows are mixed, AI is stealing attention, treasury companies are being tested, miners are under pressure, regulators are building stablecoin rails, surveillance is expanding, and Bitcoin produced another block. That is the whole story. The fiat world needs constant intervention. Bitcoin needs none. Keep stacking, keep learning, keep improving your custody, protect your privacy, lower your time preference, build your fortress, and I'll see y'all next week. Bye-bye.